Look, I'm not going to sugarcoat this. What's happening right now in the gold and silver markets is something most people won't see coming until it's too late. And by the time the mainstream catches on, the opportunity will be gone. You've got until this weekend. Maybe Monday if you're lucky. After that, everything changes. Let me explain what's actually going on behind the scenes, because the financial media isn't telling you the full story. They never do. Right now, there's a massive supply crunch building in the physical precious metals market. I'm talking about real metal. Bars, coins, the stuff you can actually hold in your hand. And when I say crunch, I mean we're looking at delivery delays that are stretching from days into weeks. Some dealers are already quoting 4 to 6 week delays on standard products. That's not normal. That's a red flag the size of Texas. Here's what triggered this. Over the past 72 hours, we've seen a convergence of events that rarely happen all at once. Central banks just reported their highest quarterly gold purchases in over a decade. We're talking about sovereign nations moving hundreds of tons of physical gold. China, Russia, India, Turkey, Poland. They're not buying paper contracts. They're taking delivery of actual metal and moving it into their vaults. At the same time, the COMEX warehouse stocks have dropped to levels we haven't seen since the last major squeeze. Physical inventories are being drained, and here's the kicker. The ratio between paper contracts and physical metal available for delivery has blown out to over 200 to 1. That means for every ounce of actual gold that exists in COMEX warehouses, there are 200 claims on it. Think about that. 200 people holding tickets for the same seat. Now, you might be thinking, okay, but this has happened before, right? The system always works it out. And you'd be partially correct. The system has absorbed pressure in the past. But there's something different this time. The players involved are different. The geopolitical landscape is different. And most importantly, the trust in the system is eroding faster than ever before. Let me take you back to a moment in history that rhymes with what we're seeing today. It was August of 1971. President Nixon walked into the Oval Office and made a decision that would change the global financial system forever. He closed the gold window, ended the convertibility of dollars into gold. Why? Because foreign central banks, particularly France, were draining Fort Knox. They were showing up with dollars and demanding the gold they were promised. The United States didn't have enough gold to meet those claims. Sound familiar? The difference today is that we don't have a gold window to close. We have a paper market that's supposed to represent physical metal, but the connection between the two is more fiction than fact. And when that fiction gets exposed, when enough people show up demanding physical delivery, the entire structure comes apart. Here's what's happening on the ground right now. Major bullion dealers are reporting unprecedented demand. Not from speculators, not from traders, from regular people who are finally waking up to what's coming. Retirees who spent their entire lives trusting the system are now calling their financial advisors, asking how to get physical metal into their portfolios. That's a seismic shift in sentiment. I talked to a dealer in Texas last week who told me something that should concern everyone. He said his phone hasn't stopped ringing. People are buying everything. Gold eagles, silver eagles, bars, rounds, even junk silver, and they're not negotiating on price. They're just buying whatever's available. That's panic buying behavior. And it's spreading. The premiums tell the story. Physical gold is trading at 4 to 6% over spot price. Silver premiums are even higher, sometimes 8 to 10%. That spread between paper price and physical price is the market screaming that there's not enough metal to meet demand. It's basic economics. When supply can't meet demand, prices rise. But in this case, the paper price isn't reflecting reality yet. It's still being suppressed by the futures market. That disconnect can't last. Now, let's talk about what's driving this demand, because it's not just one thing. It's a perfect storm of factors that are all hitting at once. First, inflation. Real inflation, not the cooked numbers the government publishes. Anyone who buys groceries, pays rent, or fills up their gas tank knows that prices are out of control. The purchasing power of the dollar is evaporating, and people are looking for ways to preserve their wealth. Gold and silver have been money for 5,000 years. They've survived every currency collapse, every empire's fall, every financial crisis. That's not a coincidence. Second, the banking crisis that everyone seems to have forgotten about. Remember when Silicon Valley Bank collapsed? When First Republic went under? When Credit Suisse had to be absorbed by UBS? That wasn't resolved. It was papered over with emergency lending facilities and government guarantees. The underlying problems, The unrealized losses on bank balance sheets, the commercial real estate exposure, the duration risk. None of that went away. It's still there, festering beneath the surface. And here's what most people don't realize. When banks get into trouble, when the financial system starts cracking, the first thing that happens is a flight to safety. And in a world where trust is breaking down, where currencies are being debased, where governments are running trillion-dollar deficits, safety means hard assets. It means gold. It means silver. Third, and this is the big one, the geopolitical realignment that's happening right now. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working to create an alternative to the dollar-based system. They're settling trade in their own currencies, they're building payment systems that bypass SWIFT, and they're backing their currencies with gold. Think about what that means. For decades, the dollar's dominance was guaranteed because oil was priced in dollars. If you wanted to buy oil, you needed dollars. That created automatic demand for U.S. currency, but that's changing. Saudi Arabia is now accepting yuan for oil sales to China. Russia is selling energy to India in rupees. The United Arab Emirates is settling trade in local currencies. The petrodollar system is being dismantled piece by piece. And what are these countries doing with their dollar reserves? They're converting them into gold. They're not stupid. They see the writing on the wall. They know that the dollar's purchasing power is going to continue declining. They know that U.S. debt is unsustainable. They know that at some point, there's going to be a reckoning, and they're positioning themselves for that moment. Here's a story that illustrates what's really happening. There's a central bank in Eastern Europe, I won't name which one, but they made headlines a few years ago when they repatriated their gold from storage in London and New York. They physically moved hundreds of tons of gold back to their own vaults. When asked why, their central bank governor said something revealing. He said, "We want to make sure our gold is actually there." That statement should send chills down your spine, because what he's really saying is that they don't trust the system anymore. They don't trust that the gold they're told they own actually exists. They want physical possession, and they're not alone. Germany repatriated their gold. Austria did the same. The Netherlands brought their gold home. This is a trend, and it's accelerating. Now, while all this is happening at the sovereign level, there's another dynamic playing out in the retail market. Individual investors are starting to understand that their wealth, their retirement savings, everything they've worked for, is at risk in a system that's fundamentally broken. I want you to imagine something. You've spent 30 years saving for retirement. You've got a 401k, maybe an IRA, some stocks, some bonds. You've done everything right according to conventional wisdom. And then you start noticing things. Your grocery bill is 50% higher than it was 3 years ago. Your property taxes keep going up. Your insurance premiums are through the roof. And when you look at your retirement account, sure, the number is bigger, but you realize it doesn't buy what it used to. The purchasing power is eroding faster than the account is growing. That's the reality millions of people are facing right now. And they're starting to ask the question, how do I protect what I've built? The answer, for a growing number of people, is physical precious metals. Quick aside here, because this is relevant. If you're sitting on $100,000 or more in retirement accounts, there's a way to get physical gold into those accounts without triggering taxes or penalties. It's called a gold IRA. I put together a free guide that explains exactly how it works, what the rules are, and how to set it up properly. It's in the description below. Worth checking out if you're in that situation and you want to add some real asset protection to your retirement portfolio. All right, back to what's happening this weekend and why timing matters so much right now. The precious metals market operates on a weekly cycle. Dealers place orders with their suppliers, usually on Mondays. Those orders get filled throughout the week. By Friday, they know what inventory they'll have for the following week. Right now, we're heading into a weekend where inventory is already tight. Demand is surging, and there's a real possibility that by Monday morning, availability is going to be significantly worse. Here's why. When people see prices starting to move, when they see premiums rising, when they hear about delivery delays, it triggers a psychological response. FOMO, fear of missing out. And in the precious metals market, FOMO can create a self-reinforcing cycle. People rush to buy, which depletes inventory, which causes delays, which makes more people rush to buy. It's a feedback loop. We saw this happen in March of 2020 when the pandemic hit. Physical gold and silver became almost impossible to find. Dealers were sold out. Mints couldn't keep up with demand. Premiums exploded to 20, 30, even 40% over spot price. And if you waited, If you thought, I'll buy when things calm down, you either paid through the nose or you couldn't get metal at all. The smart money didn't wait. They bought when everyone else was panicking about toilet paper. They understood that a global crisis, a currency printing spree by central banks, and a supply chain disruption was the perfect recipe for a precious metal shortage. And they were right. We're in a similar moment now, except the underlying fundamentals are even more extreme. The money printing in 2020 looks quaint compared to the debt accumulation we're seeing today. The geopolitical tensions are higher, the trust in institutions is lower, and the physical market is tighter. Let me give you some specific numbers that should concern you. The U.S. Mint reported that Silver Eagle sales in the most recent quarter were up 68% year over year. That's not a small increase. That's a massive surge in demand, and the Mint has already had to ration sales to dealers because they can't produce enough coins to meet demand. On the gold side, central bank purchases hit their highest level in over 50 years. We're talking about 1,100 tons of gold purchased by central banks in a single year. To put that in perspective, that's more than the entire annual production of the top 3 gold mining companies combined. Central banks are vacuuming up supply. And here's the thing about central banks, they don't sell. When they buy gold, it goes into their vaults and it stays there. That metal is effectively removed from the market permanently. So every ton that central banks buy is a ton that's not available for anyone else. Now combine that with the fact that gold mining production has been flat to declining for the past few years. We're not discovering new major gold deposits. The easy gold has been mined. What's left is deeper, lower grade, more expensive to extract. The supply side is constrained, so you've got surging demand from central banks, surging demand from retail investors, and flat to declining supply from miners. What happens when demand exceeds supply? Prices rise. It's not complicated. But the paper market, the futures market, is still pretending that everything is fine. That disconnect is going to resolve, and when it does, it's going to be violent. Let me tell you about what happened in 1980. Gold hit $850 an ounce. Adjusted for inflation, that's over $3,000 in today's money. What drove that? A combination of factors. High inflation, geopolitical instability, a loss of confidence in the dollar, and a physical shortage. People were lined up outside coin shops trying to buy whatever they could get their hands on. The Hunt brothers tried to corner the silver market and drove the price to $50 an ounce. That's over $150 in today's money. The market went absolutely parabolic, and the people who owned physical metal before the run-up made fortunes. The people who waited, who thought they'd buy on a dip, got left behind. We're seeing echoes of that setup today. The inflation is here. The geopolitical instability is here. The loss of confidence in the dollar is building, and the physical shortage is developing. All the ingredients are in place. Here's what's different, though. In 1980, the Federal Reserve could raise interest rates to 20% to break the back of inflation. Paul Volcker did exactly that. It caused a brutal recession, but it worked. Today, the Fed can't do that. Why? Because the U.S. government is carrying $35 trillion in debt. If interest rates went to 20%, the interest payments alone would consume the entire federal budget. It's mathematically impossible. So the Fed is trapped. They can't raise rates high enough to truly fight inflation without causing a debt crisis. And they can't keep rates low without letting inflation run hot. They're stuck between a rock and a hard place. And the market knows it. That's why gold has been quietly grinding higher. It's not making headlines. It's not getting the attention that stocks or crypto get. But it's been steadily moving up, making new all-time highs, because smart money understands that the Fed is out of options. And silver. Silver is even more interesting. Silver has industrial uses that gold doesn't. It's used in solar panels, electric vehicles, electronics, medical equipment. The green energy transition that governments around the world are pushing requires massive amounts of silver. We're talking about hundreds of millions of ounces of annual demand just from solar panels alone. But here's the problem. Silver mining is largely a byproduct of other mining operations. Only about 30% of silver comes from primary silver mines. The rest comes from copper, lead, and zinc mines. So if those base metal mines slow down production, silver supply gets hit. And right now, with economic uncertainty, some of those operations are scaling back. You've got industrial demand increasing, investment demand increasing, and supply potentially decreasing. That's a recipe for a price explosion. And the silver market is tiny compared to gold. It doesn't take much money flowing into silver to move the price dramatically. I want to paint a picture of what could happen over the next few months. Imagine you wake up one Monday morning and you see that gold has gapped up $200 overnight. You check the news and you see that a major bank has failed, or there's been a currency crisis in an emerging market, or there's been a significant geopolitical event. Whatever the trigger, it's caused a rush into safe haven assets. You think, okay, I should probably buy some gold now. So you call a dealer, and they tell you that they're sold out. They've got a 6-week waiting list, and the premium over spot price is 15%. You check online. Same story. Everyone is sold out or has massive delays. You could buy paper gold, an ETF, or a futures contract. But you've heard the stories about ETFs not actually having the gold they claim to have. You've heard about futures contracts being settled in cash instead of metal. You want the real thing, but it's not available. That's the scenario that could play out. And once it starts, once the shortage becomes obvious, it feeds on itself. More people panic. More people try to buy. Inventory gets even tighter. Premiums go even higher. And if you're not already positioned, you're stuck on the outside looking in. This is why the weekend matters. Right now, today, you can still call a dealer and get metal. Maybe not instantly. Maybe there's a week or two delay. But you can get it. By next week, that might not be true. By next month, it almost certainly won't be true. I'm not trying to create panic here. I'm trying to give you information that you're not getting from mainstream sources. The financial media is focused on stocks, on the Fed's next rate decision, on corporate earnings. They're not paying attention to what's happening in the physical precious metals market. And by the time they do, by the time CNBC is running stories about gold shortages, it'll be too late for most people. The wealthy, the connected, the people with access to private banking and institutional dealers, they're already positioned. They've been accumulating for months. They understand what's coming. The question is, are you going to wait until everyone else figures it out, or are you going to act while there's still time? Let me give you one more historical parallel, because I think it's instructive. In 2008, when Lehman Brothers collapsed and the financial crisis hit, there was a brief moment where gold actually dropped in price. People were selling everything to raise cash. But within weeks, gold started climbing. And over the next 3 years, it went from $700 to $1,900. It nearly tripled. The people who bought during that initial panic, when everyone else was selling, made incredible returns. The people who waited, who thought gold was too expensive at $1,000, at $1,200, at $1,500, they kept waiting. And they either bought at much higher prices or they never bought at all. We might be in a similar moment right now. There's uncertainty. There's volatility. Some people are selling to raise cash, or because they're scared. But the underlying fundamentals, the reasons to own gold and silver, are stronger than they've ever been. The debt is higher, the money printing is more extreme, the geopolitical risks are greater, the trust in institutions is lower, and the physical market is tighter. Every single factor that drives precious metals prices is flashing red. So here's what you need to understand. This weekend, you have a choice. You can take action, you can position yourself in physical gold and silver while it's still available at reasonable premiums. Or you can wait and see what happens. You can hope that everything works out, that the system holds together, that there's no crisis, no shortage, no price spike. Maybe you'll be right. Maybe everything will be fine. But what if you're wrong? What if the shortage materializes? What if prices gap higher? What if you can't get metal when you finally decide you need it? That's a risk you have to weigh. I'll tell you what I'm seeing from people who understand markets, who've been through multiple cycles, who've seen how these things play out. They're not waiting. They're buying now. They're taking delivery. They're securing their position before the crowd figures it out. Because here's the thing about crowds. They're always late. They buy at the top. They panic at the bottom. They follow the herd right off the cliff. The people who make money, who protect their wealth, who come out ahead, they're the ones who act before the crowd. They're the ones who see what's coming and position themselves accordingly. You've got until the weekend, maybe a few days beyond that. But the window is closing. The inventory is depleting. The premiums are rising. The delivery times are extending. Every day that passes, the situation gets tighter. This isn't about getting rich quick. This isn't about speculation or trading. This is about protecting what you've built. This is about making sure that when the system cracks, When the currency loses value, when the banks get into trouble, you've got real assets that hold their value. Assets that have been money for thousands of years, assets that central banks are hoarding, assets that you can hold in your hand. Gold and silver aren't going to make you wealthy overnight, but they're going to preserve your wealth when everything else is losing value. They're going to give you options when other people are desperate. They're going to provide security when the system is failing. And right now, while you can still get them, while the premiums are still reasonable, while the dealers still have inventory, you have an opportunity that might not be there next week, next month, or next year. The choice is yours. You can act on the information I've given you, or you can wait and hope for the best. But understand that waiting has a cost, and that cost might be higher than you think. The smart money isn't waiting. The central banks aren't waiting. The wealthy aren't waiting. They're moving now. They're securing their positions. They're preparing for what's coming. The question is, are you going to join them? Or are you going to be part of the crowd that figures it out too late? You've got until the weekend. Don't wait.